Hello, I'm Ivan Gruhl, Chief Investment Officer with Avantax. Today we'll provide a market update for September. We'll start with a recap of returns for August and then shift to an update on the Federal Reserve, the budget deadline, tariffs, and our outlook going forward. Stocks finished August in positive territory in a month that saw market strength broaden beyond the Magnificent Seven. The S&P 500 tacked on 2% in total return during the month, while the Russell 2000 played catch-up, rallying more than 7% after a sluggish start to the year. Overseas, international markets improved on already strong returns, with the International Developed Index adding more than 4% in total return, while the Emerging Market Index gained about 1.5%. Stocks around the globe are firmly in positive territory for the year, with international markets continuing to lead the way. Through August, the International Developed Index is higher by more than 23%, with emerging market stocks up nearly 20%. Here in the U.S., the S&P 500 index is higher by nearly 11%, and the small-cap Russell 2000 index is now up more than 7% year-to-date. The month of August brought a welcome rally in both taxable and municipal bonds. The taxable bond index gained 1.2% in total return for August, while the municipal bond index added about 0.9% in total return. The taxable bond index is now higher by nearly 5% on the year, while the municipal bond index continues to lag, higher by just 0.3% in total return through August. Shifting to the economy, market participants remain squarely focused on the prospects of interest rate cuts in the month ahead. Heading into August, the markets were pricing in just a 40% chance of a rate cut at the Fed's next meeting on September 17th. However, a weaker than expected jobs report in August, paired with Fed Chair Powell's speech at Jackson Hole, sent rate cut odds surging higher, as the probability of a 25 basis point cut in September now sits around 90%. With the prospects for an additional rate cut in October or December, this could bring the upper end of the Fed funds rate from 4.5% currently to 4% by year-end, with expectations for more rate cuts to come in the year ahead. While the near-term interest rate outlook appears to have become clearer over the past month, there are several unknowns that could lead to volatility in the weeks ahead. As Congress returns this month, the September 30th budget deadline looms large. Keeping federal agencies funded and avoiding a government shutdown has become increasingly difficult in recent years. As this chart shows, there have been 21 partial government shutdowns since 1976, and while not a good predictor of future returns, shutdowns have been associated with elevated volatility in the short term. Elsewhere, President Trump's aggressive trade agenda hit a snag at the end of August when a federal appeals court ruled that most reciprocal tariffs are illegal. For now, the appeals court ruling states that duties on goods from most countries will stay in effect until October 14th to allow the Trump administration time to appeal the decision to the Supreme Court. It appears that sector-specific levies, such as those on steel and aluminum, remain safe. The primary concern for the markets stems from the idea that the U.S. could potentially have to refund the billions brought in from tariff revenue, putting further pressure on the fiscal situation. Bringing it all together, September has historically been a challenging month for stocks. Just one of 2 months where the S&P 500 has experienced negative returns on average dating back to 1928. With the markets trading near all-time highs and crucial labor market and inflation data on the docket prior to the Fed's interest rate decision later this month, we think the environment is favorable for market volatility in September. With that said, we remain focused on the long term. The economy continues to expand, corporate earnings remain resilient, inflation appears to be contained, and lower interest rates are likely on the horizon. In aggregate, our outlook remains optimistic for both stocks and bonds, though we anticipate the path forward could become a bit choppy for the remainder of this year. That's what we have for this month. Thank you for watching and have a great day.